David, thank you so much for joining us here at SuperReturn International. It's great to have you back here in Berlin.
Yeah, it's fantastic to be here. Thank you for having me.
So many of your colleagues here, 4,000 members of the industry. A great chance for you to have discussions around what's the state of play for the European credit market at the moment.
Sure. Yeah, look, I think credit's more exciting than it's been in a long time. As pension funds manage money, a lot of them trying to make 7, 8%, 9% returns. When European credit, when I started AlbaCore, in 17 and early 18, the high yield market was yielding kind of sub 3% at some points. So it was a bit boring for people. I think today we're seeing opportunities in first lien lending and private credit to make 10, 11, 12%, which really fits into portfolio as well. So there's a lot more interest, I think, in credit and probably more allocations coming our way.
You're sounding incredibly optimistic given the sort of current economic, geopolitical environment that we're in. Why is that, and what's sort of shoring you up? What strategies, what geographies, what sectors are you interested in that's making you feel optimistic?
Sure. I would say we're optimistic about, fund flows. You look at just allocations, credit, is just more interesting at 10% than 3%. So there was more about that. I think there's definitely risks. One thing we're seeing is any 2019, 2020, 21 LBO, as that debt's coming due, that may have been a 5 times levered deal and a coupon of 4.5. Now it's going to be a 4 times levered, a 3.5 times levered at 10%. It's challenging for the private equity players to refinance the debt. And so the conversations around maturities are much harder than they used to be, because when the rate environment's dropping, refinancings are, everyone's happy, you get refied, the rate goes down. Now all the refinancings cost more. So I think that is the one big kind of risk factor, is that companies that have kind of an older balance sheet, maybe a bit more leverage than they would have today at a lower cost of capital, when they go to recut that deal, refinance that deal, it's challenging.
And you're seeing longer holding periods generally as well.
Absolutely, yeah. We hear, obviously on our side, as we run our business on the close-end funds, we've done this for, as a team, 13, 14 years, going back to CPPIB. And the average hold was 3 or 4 years. Now it's longer because there's not an easy exit. As I mentioned, the refinancing's hard, the multiples are lower, maybe EBITDA didn't grow as quickly as it could have, and so we're seeing longer holds, which means probably better money multiples in the vehicles, but maybe lower IRRs as well.
So what are you seeing in terms of those capital structures in this sort of higher interest rate environment?
Yeah, so you've got to, if you're carrying 10% debt versus 4% debt, you can carry, 2.5 times less debt. So if your leverage was 5, maybe now it's 2.5. If it was 8 times levered, maybe now it's in the 4s. And so we're definitely seeing a step change in multiples at higher interest rates. And that's why as a lender, I mentioned the optimism, and it's interesting. You're getting paid a lot more for less risk, for a lower multiple attachment point. But it also means that private equity buyers have to pay less for companies. And this now causes a bit of a stalemate, because someone maybe, a good company was 12 times, now maybe it's 10 times, and an average company was maybe 8, now it's 6 times. Exiting those deals for the PE firm selling is not so easy. So we're seeing muted M&A activity, we're seeing the level of LBOs dropping, and so the volumes are down a lot because the bid-ask spread is still quite high. For the deal that was done 3 or 4 years ago, the multiples probably are lower today.
I've heard some people say that in this environment, obviously in the past when everybody says all boats rise, and all of that. So are we going to see the really good players coming to light now, because those that haven't done their job as well as they should have done are going to come to light too? Is it going to be quite a revealing period for the private equity industry?
Oh, I think, look, whenever you have defaults going up, a default, essentially when you have a default, most likely the equity is a 0, in the default, and typically. So they were running 0%, 0 to 0.2, 3, very low default rates, even through COVID, of course, with the stimulus. And today we're seeing them pick up. So there's more and more lenders. We have a few examples at AlbaCore, and other managers have. If you have 200, 300, 400 loans and you have a few percent default, you're going to get 5 or 10 names over the next few years. And that's going to make it challenging, of course, for the returns. But there are some players. I think the one thing we see when private equity firms are responsible and kind of way ahead of the schedule, refinancing debt and pushing out maturities, they tend to do better. The ones who have gotten in trouble have been a bit too cute and letting things go a bit too late, 2 years to go, 18 months to go, and then something happens, maybe a bad quarter, and they can't refinance the debt. And so I think you will see definitely different returns than historically. And again, longer hold periods, probably lower IRRs, decent money multiples, but there'll be more winners and losers with defaults picking up.
I saw you a year ago here. What conversations will be having this year with some of the 4,000 members of your industry that are here compared to what you were talking about last year, perhaps?
Look, it's probably the activity, the difficulty and the amount of energy spent on refinancing. It's not so easy. So there's a lot more difficult conversations. If there's a debt coming due, in the old days, the last maybe decade, there was an A&E and it meant an extend conversation, a 1-point fee, a bump in the coupon, and people kind of smiled, signed, and went on and took a day or two. Now that conversation is tougher, where the answer is no. The reaction is, we're not going to amend the debt. You need to de-lever a bit. You need to pay us a lot more. You need to tighten up the baskets. You need to give us more collateral. You need to put in equity maybe. So that conversation, I think that is a lot of energy being spent at AlbaCore Capital Group, at other firms. And when the conversation doesn't go well, then we've got to, hire advisors and protect our investor capital. But I think that's the biggest thing we're seeing, is just the amount of energy spent as things come from maturity. Not everything's maturing as easily as it would have done probably from 2010 into 2022. In 23 and 24, it's tougher.
Yeah, slightly tougher conversations than this time last year, perhaps.
Yeah, and we're partners and we're long-term players and we're all friendly, but at the end of the day, we have to protect our LP capital, and we have to do what's best for our partners, our limited partners.
Just finally, if somebody was to leave having had a chat to you this week, what would you hope you'd have imparted about what your approach is in this environment and what private equity should be perhaps doing in this environment? Look,
I think there's a lot of risk. So I was optimistic at the beginning about maybe allocations and kind of where credit stands today. But nonetheless, there's a lot of risk, around the world, whether it's China and Taiwan, oil prices, energy prices, politics, US politics, European politics, inflation, interest rates, a lot of things going on. Not all the companies are hitting their numbers. The pro forma adjusted numbers aren't coming through for some companies. And so there's a lot of risk. We've got to be very, very careful. Having said that, for today, good businesses, good transactions, well-structured, they pay a lot. And so we're balancing, of course, a bit of optimism and excitement about what we're getting paid and the risk we can take, with also acknowledging that the world is risk, and probably where the liquid markets are trading with equities and credit spreads probably aren't reflecting fully some of those risks. And we got to be very careful, as we always are as lenders, careful what we're doing with capital and with transactions.
David, thank you for sharing your thoughts. Sure. Always good to chat to you. Thanks for joining us.
Thank you very much. Thanks.